There is no comparison between my fund and crypto because crypto does not produce income. It's not a productive asset. To sell your crypto, you just have to wait for it to go up and find another buyer, another fool, if you will, another believer. I mean, I don't want to call them fools. I don't know. I mean, maybe they will make money, but that doesn't mean their assets are performing properly. It's not even regulated the right way yet, and you don't know what's going to happen with regulators when they get into it. The key thing is I look for productive assets, and that's what you should be looking for. What's a productive asset? Is when you put your money in something that produces income. Now the question is, how are they managing the risk? How much income? How reliable is it? And how much effort? Will there be capital calls? We have no capital calls. We've never done a capital call. We've always paid on time. We pay on February 28th, August 31st. We pay 6% on February 28th and August 31st is the payouts. So if you're getting a 6% on 25,000 to 249,000, so the minimum investment is 25,000. You will get 8% when you put 250,000 to millions of dollars. This is steady, reliable return, and you're getting it twice a year. And you don't have to do anything. You don't have to make any decisions. You don't have personal liability. We manage the risk. We reduce the risk by being diversified in many locations, in many type of assets, many style of investing, and we've done it all the time. Now, you look at REITs, Real Estate Investment Trust, you can buy shares in REITs, just like you buy shares in my private fund, and they will pay you a dividend, but it's a lower dividend usually, number one. Number two, they adjust the price of the shares. So they can pay you a dividend, and then they drop the price of the shares. So if you're selling your position, you end up breaking even or losing money. While with us, your principal is intact, it's a debt fund, so you're getting actually an interest return that is steady, reliable, and we've been doing it for years. So we manage risk, they manage risk. The whole idea is to assess the risk before getting into any investing. Our business model is focused on specific markets that we've been there for over a decade. We've seen them in different cycles, we've seen them in different predictions and trends, and we've done always well. Any deal that we do, we're very cautious about how long it will take, how much it will cost, how much it will perform. We have great relationship with banks and we don't over leverage. Our loan to value ratio is really in check and it's often less than 60% even. So if you compare it also to the stock market, well, the stock market, you can buy Berkshire Hathaway stock, Warren Buffett, that's great, but it does not give you any dividend. You'll have to wait a good chunk of years to have some cash flow. And when you sell it, you will eventually pay taxes and realize your gain. That's not bad. But it's not what I call producing that income that you need, that you can reinvest and compound your returns. So stocks, the stock market fluctuates. If you want to do stocks, I would suggest you consider the S&P 500 and consider my fund, because you would also then be diversified a bit. The other type of funds, maybe you can see equity funds, those come in with a little bit more risk and the potential of higher return. I don't know, many of them are not performing so well now that the interest has gone up. They have to actually kick some tenants out from their apartment buildings, refinance these buildings, and now the cost is higher. So those who started with interest only and then tried to refinance, now they're not doing so well. So we don't go crazy, we don't overpromise, we don't underdeliver. We have been very steady and reliable through the years. And we invite any investor to come in and take a look at the inventory of assets we have in San Francisco and the inventory of assets we have in Old San Juan, where I'm filming this right now.